Welcome, it's the Crypto Sniper. Thank you for checking in and being a fan throughout this year with us. Please smash the like button and don't forget to subscribe. I'm going to cover in this video that should be extremely entertaining. We've got energy, we've got things to tell you, we've got value add to give you. What will that take the form of? Why you should be hanging tough on the XRP long hold period, why it's been hard, why it's actually underperformed so far for a while, what's likely to transpire before it actually takes you onwards and upwards to the targets that we are expecting. Also, I'm going to talk about the most followed man on technical analysis on X, formerly known as Twitter, and how we have a contrary opinion, both for Bitcoin and Ethereum, and why it's a clash of methodologies. What is going to give the better outcome? You get to decide on something that will happen in the future. Watch what he says, watch what we say, and then go and measure us. And if we turn out to be inaccurate, remember everything is on balance of probabilities, then we will tip our hat to his correctness. So with that said, it's going to be a great show. Don't forget, you're going to enjoy this. Book a call. Remember to be part of our community in that very first link below. Watch first and see whether you like the cut of our jib if you're new in terms of the charting that we're going to do. So with that said, let's go straight to those charts. Bang. And with a clap, Aladdin appeared, and we see before us the XRP, US dollar. I'm using stamp because why? Because it has a lot of history, and it has an important little piece of history that I will be discussing in the fractals of pattern lexicons. You can see that we have, even in 2013, the existence of XRP on Bitstamp, where in many instances it was not available on other exchanges, or those exchanges did not even exist. So a simple first basis commonality that you'll notice in terms of this is this is a log scaled chart. Log scale chart, go look at the nut over there at the bottom. You're looking at one nut right here. Have a look at another one over here. There you go. There's your nut. And it says logarithmic, or you can just see the L showing it. Why? Because things move fast and really far in short times in crypto. And when you're looking at big time frames where you have previous prices that are significantly pre-parabola lower, you need to have some sense of proportionality. That's introduced by essentially looking at something instead of in the absolute number sense, but more in a log scale, which talks about percentage base of move rather than the absolute valuation. So let's go straight to this. So the simplest amongst you might indeed actually have seen that, and we have done similar before on our chats on XRP. By the way, status, all the status tokens will win out. It's a totally captured realm. This doesn't mean I approve or like of our forthcoming railways for central bank digital currencies or anything. This is a dispassionate technical assessment of something that may go up, not an approval of project or a moral stance or in any other way. In short, this is macro technical analysis just on whatever the underlying is without judgment on its fundamentals or its role that it'll play in future society. Okay, so most of you will be able to see, yep, there was pretty much something that went on in there. Now I'm going to just break this whole pattern structure a little bit further down and give you a little bit more of an idea. It's quite common that people that have a closer look get to see a little bit more. That's the difference between snipers and regular shooters. Regular shooters have a 50-round magazine and they like to empty it and then reload and do it again. Snipers actually see every single bullet as preservational and to be cherished, and they not only want to shoot the bullseye, they want to shoot the cross that's in the middle of the bullseye, and they take extra time, they focus on trigger action, they breathe deep, and they get their heart rate, they try pull that trigger in between heartbeats, so that even the slight twitch of pulse will not see a slight left or right movement in the trigger action that could marginally vary the projectile's trajectory towards its point. So in short, they don't even want to shoot the bullseye, they want to shoot the middle of the bullseye. Even when they can't see it, they visualize it. That's sniping. Okay, so let's try see a little bit more of this detail. So as a launch project fairly early in its history, this was now 2013 going into 2014, we call it church steeple, kind of very volatile. Of course, it gets the surge of the hypium and the hopium and everything. And then it gets a bit of a reality check flush out. You got a secondary push up that was a little bit less violent on the upside, and also a little bit less violent on the downside. That then gives you two very distinct impulses. Now, what tends to happen is many people miss the third impulse because they can often be low slung, they can be heavy and very grindy. A lot of the volatility has dissipated. So it's gone wild for a while, up and down, calming. So the subtleties get more hard to spot in what happened. But if you go back to the end of 2015, we'll choose the blue color now and draw this for you, you will note that you did get a very smaller channel which had a slight upside grind on it, like that, squeezy, a little bit of a channel, slightly up generally, with marginally higher highs across the top and marginally higher lows. I'm going to put a splitter on that because that's what we do, but that's more just for technical sakes. And out you go. And that is your kind of structure. And you based out on your low two. There are a couple of touches there, not too many, but one or two before you went. Yeah, so that is what happened during the back end of 15 all through 16. That took an entire year and actually then went into 17. What happened in 17? Well, you'll see actually there was a nasty old flush out. Now, remember, early doors, not so much volume, not so much liquidity, easy to trigger new people with leverage doing dumb things, putting extra zeros and selling. All sorts of things could go on. Bad data on old exchanges during early lightly traded markets. There's lots that can be said, but generally within that, you tend to still get in markets flush outs in one direction. And this is part of what we teach you in our course material, flush outs in one direction before moving strongly in the other. And that's very, very common. So I'm going to draw this one in a slightly thinner box, but I want to highlight the flush out there. Now that low actually wasn't very far off one of the lowest periods at all, and probably slightly ran these lows over here, very, very close to, if not. So it was quite an interesting, real heavy hit. So not only did you take the back end months of 15, all of 16, and then the early first quarter of 17 with a flush out to the downside, it was a real walk of the desert, only to get a slap in the face before eventually you got the good news and you got your super run. And that came in the form of this, which I'll go back up to fat cokey draw. Who loves a fat cokey to draw? I did as a kid anyway. And there you go. Run, you did. Wind up structure, we'll highlight that in a minute. And further run next stage. And this was an unbelievable move. In fact, you were around 0.06's levels. Let's just highlight that, 0.006. So that is, it's not even it's hundredths of a cent. It's 6 thousandths of a cent. It's the third decimal place. Actually, I'm wrong. It's units, tens, and hundreds. It is 6 hundredths of a cent. That's not taking the low that you got pushed out on into there. That would have probably got you very close to 0.003s, almost half that. And in the end, you ended up through $3, I believe, on that very highest moment. So you can do the maths on that yourself, but it is a very significant move. Also, once you started the pumpamental, you did get one pause period, and during that pause period, you got a squeeze, and you got continuation. One of our favorite structures, squeeze of the volatility and continuation. Why? Because you can set tight stops, you can jump back in, and you can get a real surge move with low risk, super tight, expansive reward. And often you get geometry for that. And in HVF method, we actually have structure that allows you to have overperformance closing methodology. So once you've made your target, you can close half and you can leave some on for a little bit higher up. So we'll be talking about that other technical analyst, very well followed globally on Twitter, and his opinion on the crypto markets in a short bit and why we differ. And that's okay. It doesn't make him a bad guy. It doesn't make us a good guy. It doesn't make us a bad guy or him a good guy. It's just two different opinions in the market. People talking about markets and having different opinions and different approaches and methodologies. And we'll look a little bit at that methodology that he's applied and our criticisms of the methodology, not the man. Remember, it's about a methodology and the man. Scientists do robust work on other people's scientific work, and they test the science. They don't attack the individual. So let's get on with it. This is our take on how XRP performed in its run-ups from its listing appearance on Bitstamp around the 13s, mid-2013, through to its eventual 2017, end of 17, border cusp of beginning of 18 high, which we didn't give you a full final number, but we can confirm it in the end. On Stamp, you got a intra-period high. By the way, we're on the weekly chart to get all this data. So the week high intraday was $3.31.7. $3. So if you're looking at the H up top there, you can see it, $3.31.7, almost $3.32, almost all three threes. Ooh. Anyway, let's not get stupid. Let's get straight into what the second part of this. So what I'm actually saying to you is you get fractalization in essence. And it's my assessment that you are already in a state where some of that is happening again. In other words, you get very close to similar. Don't expect identical twins. This is a far bigger cycle. This one has breached 2 cycles because XRP, as a result of the legal action and many other things, did not have a new bull high in the last halvening cycle. In fact, it only made in and around 1.9s, just got into the 1.9. So very clear first impulse again, and very clear lows into here. So here is essentially what we're drawing for you. This whole item, I can extend that all the way down to encapsulate the bull market, but we're just drawing over other drawings and I don't want to mess it up. So clear 2 impulses. What happened last time when we got a clear 2 impulses? Well, you went kind of dull. You walked a desert from the last few months of 2015 all the way through 2016. And actually, you got a flush out in 17. So everyone who was leveraged, bye-bye, you're out, liquidated, thank you. And then it pumped and did with those that remained in the real deal job that got you the macro. In short, the green boxes are the part you want. The gray secondary setup, which was the squeezy, which set up a next green box, is also a point of interest. So everything that's green and gray is great. Everything else is set up. And orange is the flush out. Danger, beware, yellow light. You're about to jump a yellow light and smash into someone, T-bone another car. Don't do it. Okay, so here comes the blues. Let's go with the blues. And you will note, if you have a look, there's been a bit of basing period. So I'm not going to draw this one exactly the same, but I'm going to highlight to you the weak upside grind channel, the roof of that same grind channel. There was a degree of basing out, which I'll do on the same thickness as our splitter line here, like that. And there's your basing there on what looks very similar. So it's a frustrating period. It's a walk the desert period, marginally higher highs, pumps that part occur and then fizzle back down. It's a spike and fizzle, typical token in actual fact. Long periods of slowly dripping back, giving up dominance, long periods, a little bit of a blip, and then back to just dribbling out until the big one occurs. Of course, dominance also spiked immensely here during this green period, and we're expecting the same. So if this is a larger version of an earlier fractal, which in itself wasn't short, don't forget, it started from the listing in 13, and your pumpermentals happened round about end of quarter 1, 17. There's your 4-year cycle. We talk about the 4-year halving cycle, how it's dovetailed with a 4-year quantitative easing cycle, a 4-year electioneering cycle. So one president that breaks the economy then signs out and leaves the mess for the next guy. All of these multiple cycles of 4 as being super, super interesting. But since 18 to 24, you're on about a 6-year. It's about 50% bigger. 13, I would say, is the start point, and the break is 17 there. So that's about a 4-year. We're on 18 being the high, but actually the high one, but actually it all started in 17 when it broke. So you're 17 through to 24. you're already on about 7 years. So this is going to be probably the 8th year it goes, in my opinion. So what are we expecting? We are expecting something similar. Why? Because they don't want you to make the money. They're going to flush you out. Before something is about to move very strongly in a direction, it's absolutely quite common. And we talk about this in our materials about the look one way, go the other way candle, the break and feign back in candle. All of these things that get everybody super excited, get them all set up, and then the opposite happens first. And this could be on geopolitical news, a bit of FUD, a bit of everything. It's ideal, and then something actually takes you down, and then in the worst possible environment, it actually sounds like it's running counterintuitively. So what comes next? Here is our scenario for you. Some form at some point, maybe not too far away, although I think it can go up a little bit first. There may be, whoops, wrong color. Let's go back and pick up our orange. So we're doing this color-coded for you in the colors of the rainbow, because genderism is so awesome, and we want all the genders to be included in this one. God knows what color an orange is, but then again, maybe it's just orange. I don't know. Orange man bad, by the way. Oh yeah. Anyway, I'm getting distracted. Sorry. So there you go. Flush out to the downside. Something like that. I wouldn't expect, with the more mature token and the higher level of liquidity that you typically get, that you would run. This wick is extreme, and as I mentioned, thin volume, folks with leverage, not knowing what they were doing, not enough bid stack, not enough bots in the system putting in bids and creating the liquidity, all of that flush you out that big. So in terms of percentage terms, I wouldn't expect the flush out to be nearly as big. Remember, these aren't identical twins. Already I'm telling you this is about 50, possibly twice the size. Twice the size? What does twice the size mean? Sidebar, before we go back to our flush out narrative. Twice the size typically means twice the move when it comes. The scale is larger in every level. The scale is larger in every level. So we're talking about giantism, big head, big feet. He's probably got a big, who knows, anything, any other part of his anatomy, your choice. Anyway, dip out, wash out, flush out. What comes after that? Then squeezy Japanesey into. Big green comes next, very promptly, usually after a very small low volatility period. You can barely see it there. It's caught up in between the orange and the green triangle. I've actually overlapped them. We go fat, and we have told you roughly where the targets are. We want to give value to the free views here in crypto to help you build wealth in these interesting and disparate times. Something like that, and then maybe a little bit of squeezy. Now we expect overperformance, so the 16.7s and whatever is our target, but we expect it to scream up possibly higher. Remember, this is log scale. That's already past $24. I'm not saying that the overperformance will do that. We have confidence in our targets. We'll take 50% off there. We'll overperformance manage using HVF method tools for doing that you too can learn by clicking that first link below and joining us and watch us do it if this particular trade does come, as we have said it may. And you can be part and parcel of seeing it live and be updated every single day. We would certainly be talking about it many times during the day when this transpires, assuming it does transpire. Everything on balance of probabilities as a potential outcome. So squeezy, that is essentially a fractal of some future larger version of itself. That is the expectation for those of you. So just to give those that are thinking, damn, he said XRP some time ago, and here I am, and ADA's been overperforming. Well, ADA underperformed for a long period. Now it's gone overperforming. I could have been that. It could have been this. This is all the dog with a bone seeing his own reflection and letting go of the bone to grab the other one. You end up with nothing. A cat on a hot tin roof. You're jumping around here, and there. You always want to be on the one that's running. You're chasing FOMO pumps. So the point of this is you could, in fact, let's use black. Oh, emo. So dark and ominous. You could in fact be in the equivalent of you are currently here right now. Now, you would probably look at that then and say it's not safe to leave town. You are here. You know those maps. I know you do. You are here. And that would be my draw right now. So let's do little arrows. Those don't like those big heads. They get too big. He's got too big a head. Don't get big headed. Okay, so that's overall where I think we could be. and you could get a little bit of upside. I'm actually expecting a bit of Santa action, but some point in January we could get that potential flush out and a little bit more underperformance. That everybody goes, oh, why am I in this token? I should be in Pumpermental, block token, or Pumpermental AVAX, or Pumpermental whatever the case may be. Don't forget, we've given you a 30 times multiple plus. In fact, it was a little bit higher when we were lower down. We are a tiny bit higher than we were when it was 47 and 49. It's now 61 cents. But as I say, you could still get a dip. So what does that mean? Limit orders below the price action could be rewarded on a dip. And it's going to be terrible news. You should put them on and automate them and leave them on, and don't let it be with leverage. Let it ideally be with investment, because the spike could get extreme, and then you could find yourself getting liquidated. So small limit orders, non-leveraged on the downside could possibly, not a guarantee. You don't always get every single aspect, but the main game are the green boxes. A continuation pattern of some sort potentially over the way that will take some time. Don't forget this continuation. We're looking on a weekly chart, guys. Everything looks small, but is actually fairly sizable. You had a localized high there until that point. I'm going to take this line off, but if you have a look at that, that was somewhere around about the end of quarter one, maybe midway quarter two, and you only really broke out of it the end of the year. So that continuation pattern took 2/3 of a year, it's safe to say, to play out. So, during that period, you go, I think it's all done. I think it's all done. I think it's all done. Oh, we missed it. Calling the top, lots of other people, You're over. You got your best days. Listen, you aren't going to be complaining on that first green box. It's probably going to be the biggest in percentage terms move, but you might be leaving quite a bit on the table. So remember, it's maximizing your gains and then getting out and selling. How many of you have round tripped on crypto entirely? Too many. The game is actually knowing when to get out. Overperformance tools will allow you to know we're done here, that entire position is closed, and your high water mark, you will still be between 80 and 95% of your high water mark, which is the height out. Most people go all the way down. If they get 40% of their highest point in equity before they close, they've done well. Some of them go all the way down and end up losing money. They go to 0 and -10, and they go for a beautiful old round trip where money washes in and washes as fast back out. In fact, they inverse adding on the way up as they get more confident because of the pumpermentals. And more people will come out and say $100 ripple, $1,000 ripple, and you've never had such bullishness, and you're punch drunk with the joys of spring, thinking it will never end. And we only tend to see what we currently see in front of us, instead of realizing there's always a time to hit the exit, and it's usually best time to leave the party while everyone else is still partying. You miss the breathalyzer test. Yeah, you miss the fight. You miss everything. You know what? Keep it tidy. You've had a good time. You're still sober. Go on home and let everybody else get into the twilight hours where things get a little bit weird. Okay, so there you go. That's a picture for you on the XRP. It's the earlier fractal compared to a future larger self option with a couple of warnings, a possibility to use buy limit orders, etc., to get in on any flush out, the possibility that a flush out might come. We always take pictures and save them, so let's do that. And we grab it, we save it, and now we have it as our potential forecast. Remember, it's on balance of probabilities. We can always be wrong in actual fact. This is a scenario cost, so it's a particular scenario cost of many. You may have multiple continuation patterns, the gray bits on the way up, more than just one. This is a bigger pattern. It's likely to express itself in a larger way. Things that were small here could be bigger there, etc., etc. So this is a diagram, and it's speculative. On balance of probabilities, one particular possibility that so far is tramlining very close to the original setup that gave it the original base. Remember, as debt markets collapse, and that is the death of money, and you have a contraction of the dark star Jupiter that was our old financial system, the wealthy aren't going to let all that money go away and their numbers go down. They need to already be in situ, which many of them already are, in the new thing that will be reinflated up so that we can still have the multiple quadrillion economy that we have, and that they are still super rich and super powerful and continue to buy influence all over the world. Okay, so that's that. What about this gentleman that is in technical analysis and is sharing his opinions on Bitcoin and Ethereum? So we will cover next. Point number 1 over XRP. You could be closer than you think. So this could all transpire by the end of Q1 and maybe sooner. But remember, this is a bigger pattern generally, so it'll drag out a little bit longer. I would say it's going to be probably almost double the length in terms of everything, but possibly 75%, 50. Don't, you know, this is an idea that we're giving here. Now we're going to go to part 2 of this video and say, why are we taking on someone's opinion and criticizing the opinion, not the man, and holding an alternative view. So this is the gentleman involved, Peter L. Brunt, Crypto News. He says Bitcoin has developed a triple price RSI divergence. So first, let's try understand what he's saying. So divergence is a very popular. It's a very popular technical analysis tool, and in my opinion and assessment, this is an overly utilized, misutilized feature of traditional technical analysis, generally. So why do you say that? Well, what is an RSI? An RSI basically is a formula. It's a maths formula that is applied on price data. So in other words, it's a manipulated version of the price chart itself. However, it has a certain rate of change element. So you're comparing, for example, the fact that this went up kind of quick in the beginning. ETF, BlackRock, ETF, sharp move up, and has since moved up at a slower rate. So you're getting what we would sometimes refer to as marginally higher highs, although we would highlight that that is not so marginal and has actually stretched in height over the previous one, which is actually not so bearish and points to another period of quite some decent acceleration. And then a catchment area at a key level, he's got 42055. I think he's just highlighting, I think that's just the current price on his dotted line. We've shown you that the 42.5 is in fact the legacy neckline. That was the big 69K head and shoulders that we haven't seen him draw. He loves head and shoulders, but we haven't seen him draw. He may have done. I'm not a regular follower. I just had this one pop up in my feed, and I think it's interesting. And as a result, you will progress decay for a while. That means churn around, respect the key level of significance before we suspect continuation. What is his insinuation that he hasn't said explicitly, but he's inferring, in my best understanding, is that because there's a divergence, price will eventually be pulled down to comply with the RSI. But hold on, the RSI is a shadow of the human being. The RSI is function of the price data. Who is the dog and who is the tail? The price is the dog. Let me just tell you, price is the dog. The heart, the muscles, the dog is in the price. The tail is what gets wagged by the brain, the heart, the nervous system, by the dog. It's the price data. The price data is what determines direction. And this, which is a lagging, that means delayed, and also mathematical, which is non-predictive, formula that people have decided has been useful as a proxy for price. So they're actually substituting the real indicator of price with a kind of formulaic lagging formula that says the rate that you're going up here, which is quite clear to see, is not to the same degree fast as the rate you went up in the original area, which of course was exceedingly fast on the base of a major surge of fundamental news, a very low volatility period, and quite dull performance that preceded it, which could have even been, as we thought was a possibility, a head and shoulder. So what's actually happening is, because I accelerate in my Porsche Turbo the fastest when I have it in first gear and I'm flooring it to the red line and switching for second, it means I'm going to slow down because the acceleration between second and third is slower. No, I'm going to go through all the gears and the rate of climb may drop, but I will be going ever faster as I hammer it down the autobahn. So acceleration is not speed. It's a first derivative of speed. What that actually says is you're going up less fast than you were at one stage going up, and you were close to peak acceleration there. Well, it doesn't matter as long as you keep going. This line, RSI, can go ever slower, ever slower. It becomes more sensitized when you've just had a very fast uptick as well. So failure to maintain that exact degree of acceleration does not translate into you're braking and you're slowing down. It just means you're not going up at the same rate as you were previously. And the automatic assumption that not accelerating at the same rate actually means you're going to stop or turn around is a false dichotomy. And this is the failure of lagging mathematical indicators applied as if they are the dominant force on the price itself. The price data determines the RSI along with the maths formula. The rate of change of the price data may be reflected in the RSI. It has no directional influence on what the future price data will be. It is just maths. Okay, maths is not predictive. Sorry. So we do not transfer, and this is why we are indicator free, apart from real primary data and volatility measures. So Bollinger Bands have volatility measures. Volume has additional new data that is predictive and leads instead of lags for major moves. So when you start seeing there's a bid stack and an offer stack with heavy offers and bids for a long time, and then you start to see volume at the same price building. In other words, the bids are clearing out the offer stack at a certain price level, bouncing around, not really going up much, coming up and down, but thinning the upper stack. You get a major histogram in volume, and the next day you've thinned the offer stack, and the market is having to now chase up as a precursor to that as you've thinned the stack. And there's been a power of buying that at the same level. People have continued to distribute and say, oh, there's still more demand. I'm unloading a line of stock. I'm unloading a line of this. Oh, they're taking it all. They're taking it all. Let's get rid of the whole position. Boom, there's news. They were insiders. They knew about it. Big move, something like that. Okay, so that's our criticism on indicator-based analysis. We do not assess that Bitcoin is about to go strongly. The next major move is to be down. We have the opinion that Bitcoin is actually girding its loins for another move to the upside. We will also deal with this Ethereum, but let's deal with Bitcoin first. So here we go. We're going over to Bitcoin. So what happened with Bitcoin? Well, long story short, in terms of the macro, let's just go up to the weekly. I've said this many times before. You might be viewing us for the first time, so we're going to leave this to be pretty fast and blunt. You can watch other videos where we've covered this repeatedly, but essentially the narrative of Bitcoin is the bookmarked head and shoulders that exist over here, the flag small right shoulder, and the 42.5 zone that essentially is roughly there, that captures the two shoulders and where we are now. So we called for this on the inverted head and shoulder, which is the other bookend. There's your two armpits. We give them names, armpit 1 and 2. That proves your shouldering. You shrink wrap the head. We are the only people that talk like this on head and shoulders. We've created the theory on the complexity of head and shoulders in that. That was your triggering event break. You would have been flushed into the red on a hammer, my apologies, a flag rally, a bear flag rally that also performed to target all the way down. That head and shoulders gave you 16.2 perfectly the low. I'll put my drawings on later. I just don't want the chart to be over cluttered in this purpose. This is the other book-ended head and shoulder. That was an inverted head and shoulder. It threw many people off because they don't understand complex heads. That is shoulder 1. That was a very spiky shoulder 2 with a big hammer rejection there. And that was your head structure over here. That was that. So this target was 40.5 up top here, and we felt the key level, that is the neckline of the performing head and shoulder, you would be part of your overperformance to the 40.5. So when you got the 40.5 target, you said we can close 50%, but I think you can overperformance manage, and in fact you could just put a second closure on 25, half the remaining position at 42.5, because we think you're going to get by and run that. That's exactly what's happened. And this is the first red candle. There's a red candle. You are stalling for the first period since you began the ETF news break. 1, 2, 3, 4, 5. That is a doji, but it counts as 6, 7, 8 weeks in a row up. first negative week. That's put the pigeons, scared the pigeons all up, and now they're calling RSI divergence on mathematical formula because you're not going up at the same rate. You can see quite clearly that the rate of ascent here is exceedingly brisk. Let's draw it properly for you. And any failure to go up at the same rate of acceleration will show up as a RSI divergence, even though you are continuing to go up. And that is, you're now in third, changing to fourth. You're now in fourth gear, changing to fifth. And largely, your foot's more on the accelerator than it's on the brake. And you're maxing out in the Autobahn now in eighth gear or seventh gear, depending on what they are nowadays. And that does not mean, because your acceleration is down, you're on previously, that your speed is down. Your acceleration is still positive until eventually it reaches naught and you meet your top end and you're belting it along on the motorway. Okay, so that is the two head and shoulders, the bookended of the bear. 69K was apex high, 15.5 was apex low. They were both the peaks of the heads, the peaks and troughs, of course, of the heads in what was a bull end of bull with a peak and a downside head and shoulders to the end of bear with a trough and a upside head and shoulders. You did, however, churn rather low and rather deep, and were running late to make that target, which started us to feel concerned that you would have pattern failure here. And then suddenly it all came to the rescue and actually made it on time. So not only do our methodology give you targets with patterns, this is the difference between the two strategies. Someone here is looking at price data manipulated, which means it's not the original price data anymore. You're changing it. It's like your body and your cells, and now you're doing DNA modification with some form of who knows? I wonder. Anyway, let's leave that one. I'm getting a little bit sidebarred there. But why not deal with the original information? And why not look at patterns that have probabilities or possibilities in some instances? Probabilities usually means reasonably high. But patterns, possibilities can become probabilities of performing to a certain level with a target. And we actually get time frames for when we think that pattern is no longer on schedule. And that's what started to happen over here. It took a long time to get go of 20.5. But what was actually happening is we had a very strong dollar period there. Then suddenly the dollar gave up on its strength, started to weaken, plus the fundamental news switched, and next thing you knew, zoop, target made in time, all at the last minute. So it was a last minute show for Bitcoin. Our time frame was up on the 16th, 17th of December, and it made it in the first week of December. Usually, we perform well in time in terms of the geometry that is being created. So that is the history of Bitcoin on the macro time frame. And in short, you are, in our opinion, in a recovery bull with an inverted head and shoulder that has performed already. So with that known and understood, the bias is generally to continuation, not reversal. So let's go back into the lower time frames and analyze where we are now. So I'm dropping quite a few time frames. We were on the weekly here. Most of this has been covered on the daily. So we're going straight to the 4 hourly. And now I'll just put some of our lines back on. There is your 42.5, the legacy neckline of the head and shoulder way back then. So you initially had this perfect symmetry above and below. As above and below. Note how you stalled before you ran the 42.5. Key levels of significance broken with momentum. They need to breathe in deep. We got to do this. We got to do this. Girding of the loins. Smash it. Then exhaustion. Overrun. You got an overrun, bit of a grind line there, and you let it go and you broke back down. So what you'll notice is you are actually swanning around like a sine wave. And this is quite common from price behavior, in our view, around the key level of significance. A little bit above, a little bit below. So what you're actually getting is $2,000 to the upside. So you can draw it over here. $2,000 to the upside and $2,000 to the downside as a measuring box. So you can go, there you go. Measuring box over performance to the upside, broken with momentum to the downside too. Please note, there you go. There's the downside break. There's the upside break. Follow through with quite some volatility. So this was the final blow off as you made our targets. You can see on Bitstamp it was 46.49, so a little bit above 40.5. Different platforms, different numbers slightly, but the variance very, very small and very low. And here is your square to the downside, also by a similar $2,000 odd. So from 42.5, you traded around about 4,100, 4,500 range, and then from the 42.5 you went to about 44.5, 44.8. So between $2,000 at the extremity, maybe knocking on the door of 2.5. So what's happened since? The volatility has died down. What's happened since is the volatility has died down on Bitcoin. You had another test, so let's cover this. That's one framing that we're giving you, the sine wave framing, the respect to the key level of significance, same amount above, same amount below. Most people look at support and resistance and they go, here's the most important line. And I'm not saying they're not important, the support and resistance. In fact, we're going to talk about support, but they don't see the significant level through the price behavior that is equidistant to the top to the bottom. And that is something that is missed on the overemphasis on support and resistance, key levels that are also significant within the price behavior. And it's hard for people to understand those, and they tend not to draw in. So a couple of other framings I'm going to give you. Over here, you'll see there was a sort of halfway mark support that occurred on the upside. There you see it over there. So that's kind of halfway between the extreme high and the 42.5. You can see there it's roughly halfway. It's kind of a partial support there. And when you extend that line, you can see it was a neckline for the M to the downside. That's the M to the downside. It's not a perfect double top. You got a bit of a blow off wick, marginally higher high, which is generally bearish. You went sideways, there's the squeeze, and then you spilled. There's your M to the downside, and now you have a W essentially draw to the potential upside over here. So what you're getting is you start to creep new significant levels as well as continuing to respect the existing one. What you'll notice on the existing one, there's the 42.5. Let me just fatten it up here. We are losing the volatility. That's how you get to go back up again more often than not. When the volatility lowers, most instances, it is generally bullish. Of course, you can get a volatility squeeze and sell off. This was after you're making new highs and just run targets of a major inverted head and shoulder pattern. So you get those exceptions, key breakdown. But generally when the volatility over bigger time is reducing, you're getting better likelihoods for bullish behavior. So over here, you will see 42.5, you traded down to around the 41.7. So you're about $800 to the downside, and then plus $800, you're going to be about 43.2, 43.3. You see it there. There's your key level in the middle, and there's your little bit above, little bit below. So you're actually having a smaller sine wave. Remember the sine wave I drew, starting to form here, a little bit above, a little bit below. This is again respecting potentially and then getting tighter and lower volatility, respecting the key level of significance, which was the neckline of the original bear with the peak 69K head that gave you all the way down to the downside. So the lowering of volatility is a positive generally for Bitcoin. The pullback on a strong move is good. So we're kind of starting to develop, and I'm going to talk about soft and hard floors now. So the hard ceiling you have yet to run, but the soft ceiling is around here. So the lower end of the rectangle is your soft and hard ceiling. So you've got soft ceiling, you can lift the panel out, there's still the air conducts and everything, there's a little bit more space in there, and then you get the concrete on the floor above. The concrete on the floor above is here so far, that's hard ceiling. This part is hard ceiling, this is soft ceiling. You start to run into trouble and you sell off a little bit there. You have the same on the floor. Guess what? It involves our target. Who'd have thought about it? Random, you may say. So random. No coincidences. Of course not. Key levels of significance. So you have your soft and hard floors around our target, like that. The 46.49. So once you start getting into the soft floor, you often get rejected back up. 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 You see a hammer here in the middle there. Rejected back up, all just bouncing in and around our target of 46.49. So what we've got is There's your burger patty with your locust patty right there in the middle there for you, brought to you by the World Economic Forum. There's your bread top and your bread bottom, and a bit of garnishings in between there to sweeten up the bitter insect feed. So there you go. That is kind of your range, and you're getting a squeeze. Now what you're starting to see is that the lower end is actually not going so low so far. Now that might change. The higher end is bumping up into an area that is soft resistance that we highlighted was soft support for your M. Remember that over there? Well, now that's become a new significant level on a smaller time frame. The dominant one is the 42.5. It's got real history. But right now, on the lower time frames, you start to get subplots, smaller subplots. So the breakout of 43.2, you set your alert there. Watch me do it. Do the same things for you. Is a positive event. That means for the first time since the original highs. Let's get rid of the line draw. Thank you very much. Give me the alerts, please. When you start going above the 43.2 or these highs, we give a little bit of alert just before. That's not too far away, the price reaction, and now you're making a new high. Now you are getting back into the soft and hard ceiling of this beautiful World Economic locust burger at the 42,500 burger that you're getting involved in. So that starts to point in. You want an alert when you break these highs because that will be significant. The staging area will be over. This should be treated initially as by default as continuation. Most things are continuation. How does it become more threatening as a reversal? It becomes more threatening if you get, let's move this away. It becomes more threatening if you got something like a descending triangle and you keep revisiting the floor down here and you're looking for the trapdoor. Now, descending triangles aren't always downside breaks, but the failure to make new highs. Now, because we've literally made the same high here already, it's more like a ledge with this new smaller subplot key level that we've already highlighted than a descending triangle. So it's already, for me, moving away from that. But let's say we got a really nasty sell-off wick and it came down hard and then you bounced around and you had more hang time here. Now, you noticed you had a fair amount of hang time here. You did a double bottom, by the way, on a smaller time frame right here, another W bottom. You see you get a subplot neckline even here, boom, roughly the same distance as the other one. You see that? There's your other one, roughly the same distance from your key level. You get that. You see, should probably use another color. Switch it back to transgender pink. There's your double bottom, and you can see you got supported there, and you dovetailed around it, and then you eventually gave up the goats, and then you got supported here. So that becomes a little bit of a squeezing range, just like this, because you were resisted a couple of times here and here as well as there. So now you're getting a little bit of a squeezing range, and you are respecting and bouncing. Look at that hammer there quite clearly. So that is the breakdown, technically, using candlestick analysis. No indicators of mathematical formula. However, you can use volume. We'll show you how it works. Now, what would I expect to see if this was going to break down? I'm assuming, from what I've understood from the tweet that Peter Brunt, one of the most followed technical analysts on Twitter, how many followers does he have? Probably worth following. The masses can't be wrong. I follow him too, we'll have a look. He's got 372,000 views on this chart. That means there's roughly 373,000 people that actually have considered the contemplation that he's going down. I'm trying to save some of them. I don't have that. I won't have that number of views for all the tea in China. Well done to him, by the way, for being popular, well liked, and attaining that. So he's successful in other ways too. But we differ. And we're trying to try save some of those views from maybe being wrong, because we think, hold on a minute, we're not sure we agree. Remember, disagreement at a technical level is not a personal slight on things. We are wrong and right on many things, and he will be right in many occasions where we see the market differently and will be wrong. But our methodology, I feel, is more robust. Why? Because it's based on real, fresh, separate reasons, not based on price data integrated reasons. So fixed range profile, we take from the candle that runs the pullback low. So we want all the data when you first hopped onto the ledge, the lowest point ledge of this. So we are capturing volume by price. People use volume by price incorrectly. You should, in my assessment. Why do I say that? This is Bitstamp, by the way. I'm also going to do Binance because it's a higher volume exchange. And of course, you can do the catch-all, which is all BTC as well, which might even be even better. So the key point that I'll be making is when you are likely to break down, generally you are looking for the trapdoor. People are knocking on the floorboards looking to hear, where's the trapdoor? We want to fall into the basement. Yep, that's how it works. Now the volume tends to show that. What we've actually found is we found endorsement for a key level of significance that I drew on a small pattern W bottom, which had a neckline there that had support there that I highlighted there and further highlighted there and further highlighted there. You pivoted around it and further support there. So we're actually showing that some of the biggest volume is quite far the way into a World Economic Forum burger. I would say it's 40% off what we called our hard floor down there, where the first low and the soft floor area. In the same way, again, hard ceiling, let's draw it in, and soft ceiling as well. So there you go. So you've actually got quite a reasonable point, and there's quite highly stacked just in and around it up to our 42.5. Now, I also want to talk about the overall profile is very much in the boobs and bellies variety. I would call this one a bit of a pregnant lady. The belly is winning out, but you do actually, even though it's outside the 70%, you do actually have a couple of clusters quite high. So what tends to happen is they take the most populous and then they work what will give us 70% of all the activity in and around the point of control. It's called the point of control. So what you get here is you get a box here. And guess what? It's pretty much around, slightly heavier, but pretty much around our World Economic Forum locust burger patty. That's your 70%. However, these guys by size are actually larger than many of the ones that have been included, but because they're a different part of the anatomy and price range, they're falling into the boobs instead of belly range, and you're picking up mostly the sternum and lower sternum before the belly and the pubic bone area, dare we say, of the 70% down here. So you've got to watch out for this, and you've also got to have a look at it on other exchanges. So we found our key level of significance was well supported on volume. Is this what I would expect it to be? I would expect if we were going downside, and that would also point to, say, a descending triangle type structure, how would I expect the volume by price? I would expect something more like that. It wouldn't be perfectly like that. And it doesn't have to have the most volume on the very low, but it would be close to that. Like that, and you could have a few, odd ones. It's not, this is diagrammatic, remember, and you'd be quite thin up top. We're not got that. But hold on, it's Bitstamp. Bitstamp isn't necessarily the biggest exchange of them all, so let's get BTC on Binance. I still think it's probably the biggest. You tell me if not, and let's do the exact same thing on Binance. So when you're looking at volume data, remember, it's only exchange data for that particular exchange. So how has everyone been trading on one of the biggest? Again, there, done. Okay, now you're seeing much higher participation, and we're getting close to the high line level of this price behavior being included in the 70%, and it's literally the second biggest histogram. The second biggest histogram. So were we to get up here and trade around a bit here for a while longer and off and down and around and bounce again here, you would start to get the accumulation of this zone getting higher. That red line moves all the way up to there. It then becomes what we call a ceiling tap. Where's the loft? Not where's the basement. Where's the loft? Not where the basement. Where is the biggest skirmish taking place, where the market is interacting highly? Big distributors meeting strong buyers. And that is what I think will come next with this. And that point of control can move quite far, as it would, because it would likely move to the number 2. If we fail to trade at this price point anymore, this histogram does not get higher. Remember, or further right, let me say. It's a horizontal histo. Let's get my words correct here. So overall, that is our anticipation. In short, we disagree with the RSI prosthesis being put forward. We think it's a weak argument. It's an argument. We think it's a weak argument. It's typical of traditional technical analysis. It sells courses. It creates all sorts of voodoo that people stop looking at the primary price and they start looking at price substitutes and accelerations and rate of change versions of price and lagged versions of price and smooth versions of price, except the actual price. The price is the primary indicator. The volume is a secondary indicator. The volatility is your third and most useful other indicator. Anything else that tries to take you away from the primary aspects of price, volume, and volatility. And patterns are your greatest gift. There you go, guys. That's your focus for success in technical analysis in the worldview of the man behind the white glasses. He's saying that to you, and he's saying everything else is non-productive. It gets you looking at many things. People will put 3 indicators up and say, look, I've got 3 separate independent reasons why I should be long. That is prompts and nudges that you are creating to push yourself to do something that you're not quite sure you should do. Those are all based on price. You can have an RSI, a MACD, a stochastic flip. They've created, people that sell courses have created all forms, and everybody's wanted to get their name associated with the indicator. By now, I could have had a Hunts indicator that did something. I just won't do it. If it's not based on primary data, I won't do it. Patterns are king. The HVF method, which does have my name, is a pattern, a unique pattern which involves volatility, volume, structure, yes, and is all drawn on the price, not on some proxy manipulated by a mass formula which has no predictive value. Hear me now. That is our grand criticism. So what was said on ETH? Bitcoin largely looking good for our view, and we would longer term expect upside breaks. We will be wrong if the hard floor fails before the ceiling does. So if we break through the ceiling is defined by the 44.5 range. Put your alerts. The floor is determined, the low in and around here is if we break out of the 40K range. So if we get 39 anything, it's wrong. That's the contest right now. Are we going to trade that or that? And we will see in due course how that pans out. And as ever, we could be wrong, but I don't think the methodology would be wrong. This is always on balance of probabilities. It's a skew of probabilities. People that are using wrong methodologies can still be right in the markets for the wrong reasons, and people that are using accurate or worthwhile methodologies can still be wrong for the right reasons. So you kind of get us. It's a probability game. Over the long run, people that do the right things in technical analysis tend to have better outcomes and are focused on risk-reward scenarios, not indicators. Okay. Let's get on to Ethereum and what was said on Ethereum, and then we are done with this video. Are you liking it? Are you learning anything? Are you liking it? Are you learning anything? If you just learned something, or you felt you learned something and you thought it was authentically delivered, you hit that like button to help us. We say weird things and we get into trouble with the algorithm. We're going to try say less weird things, but help us promote better thinking in technical analysis in the market, if you feel that's what this represented. Okay, so Ethereum, the case as pronounced here, all the while the upper boundary of the rising wedge in ETH continues to provide resistance. ETH is a rising wedge, not an ascending triangle, although rising wedges can become running wedges. That's what's being stated. This is the chart. So do we concur? Now, what is he generally saying? Most technical analysts think rising wedges are bearish structures. There are 2 outcomes that we've defined that are the traditional typical bearish structures. One involves a pop out the top, which you could argue has already occurred on this chart, and then a subsequent breakdown. We call that type 2. The others, you don't even get the pop out the top. It stays within the boundaries. It falls to the low. It crawls along and breaks down. That's a type 1, the most cleanest and simplest. And then we talk about the type 3, which is actually a melt up out of wedges. Now, people don't talk about this in traditional technical analysis. They don't like things that don't comply to the expected outcome. But in actual fact, many wedges pop out to the top. In fact, here in Bitcoin, you certainly had exactly that. So here you go, here you go. Let the draw lines come back. In fact, this is Binance. I've done all my draws on Bitstamp. There, right there, is a rising wedge that ran our target. So when we are in expectation of a major target run and we have a rising wedge, it is a squeeze of the volatility without having a key resistance points. You're making marginally higher highs. Normally bearish without context. Remember, in technical analysis, it's what's the context. We have a target sitting right here at 40,500. That was roughly there. I'm sure I had this drawn. There you go. I'll go back to Bitstamp in a minute because it's all drawn on there. But there is a rising wedge, and it's quite clear as an example of a melt up that took out both our 40,680 and the 42,500. The expected performance of the original inverted head and shoulders that had the ultimate trough of 15.5 low that was called by the original head and shoulders at 69. I don't see anybody talking about the book-ending head and shoulders for the bear market. But that's us. We understand complex head and shoulders. We wrote the theory for it. And you can find it all in the link below and watch us implement it. That is why we have a unique framing on the crypto markets, because we're only interested in price, pattern, and the core fundamentals. Debunking things that do not add value and eliminating and decluttering is the biggest job once you've read every book on every piece of nonsense that exists in technical analysis. And that's why many people say TA doesn't work, because there's too much mess that doesn't contribute, that needs clearing. Okay, so rising wedges do happen. Let's go to that ETH. So one of the statements that were made on the Ethereum, I think it's here, is that Ethereum is also in a rising wedge and due to go down. I'm going to remove the volume for now, the histogram volume. It's a bit a messy chart to start off with. Let's just do this. And let's get to the bigger time frames. We go macro to micro generally. So one of the things is it's a rising wedge, not a ascending triangle. Well, on the dollar, it is a rising wedge. On the dollar, it is a rising wedge. Why? That is higher point than that point. So the typical traditional technical analysis framing is that you don't have an obvious resistance. You are creeping through obvious resistance. And this was the period that you have popped out that he had referenced. So you saw the green shading that he had on this. And as a result, the implication he is suggesting without saying it, so he's being a little bit foxy, is that he's implying things without saying it explicitly in some senses, where we have to interpret in terms of what you think he's saying. So all the while, so he's been the first post is bearish concern for Bitcoin, divergence. That's what I'm interpreting that to be. We'll give him a like. Thank you for the conversation piece. And we've got a green pop out the top, rising wedge. Implication for most traditional technical analysts, downside is and it's not an ascending triangle. Ascending triangles can be quite bullish. They break upside. It's a flat resistance at the top. Now against USDT, his statement is correct. It is not an ascending triangle. It is a rising wedge. However, an interesting point, and this is why what we do of cross analysis is very, very interesting, is if you go to, let's go here and get ETH EUR. So let's say you're a European right now, and we'll take Binance and draw it. And we'll again remove the volume. We don't need that right now. Declutter the chart a wee bit. And we'll take it to 3 days. We want a bit more detail. It's only because he's chosen to measure it against the dollar. In actual fact, if we go to the euro, which was strong at a period when the dollar was weak, you actually have a high here of 1,978 and a high here, 1978, remember that number, of 1949. 78 is actually higher. So in actual fact, this one, just by virtue of the lines you can see we've already put through, they were very critical, 1900, 2000, is in fact an ascending triangle up to that point. And you did just have a break, pull back, and push up. And in fact, this particular cross pair is bullish for us, and it will go up against the dollar too. In other words, it's going to be a type 3 rising wedge on account of the fact that it is one of our primary patterns that we like. And we're good at spotting the patterns we like because we spend most of our time looking for them. So we specialize. That's what snipers do. They do reconnaissance, resting, sleeping, observing, and occasionally, very rarely, shooting. When the probability is high, the headshot is guaranteed, and they're actually looking for the specific point through the head that they want to go through. So even when the wind comes, they actually get the full benefit of it. So let's go. Let's draw, and I'm going to show you a quick draw tool that we've designed, and I'm actually going to draw this that way so it happens quicker. And I'm going to change the setting, and this is what you do when you do something really specific. You end up developing very specific tools for specific draws. So let's get that back out. What have I now done? So on Ethereum against the euro, I'm just going to take the 1870 out. I'm also going to put the 2000 in. I'm going to change that to the 2000. The 2K is a very significant number in the same way. Whoops, too many zeros. There you go. Now, key levels of significance. Just failed to make, just failed to make. Touched, pull back, wound up, little squeezy. On a smaller time frame, you'll be able to see that. Another one of our favorite patterns. Push through and down. Where did it squeezy? At our interim level rest point. You see that? It broke our interim, touched the magical key level of significance, pulled all the way back to our funnel entry, which is your last moment of entry, just in time, settled on that, wound up, broke higher, now making a hammer on the 2K after a technical run. Another key level that's significant for us. It's not on his chart. He's looking at rising wedges on the dollar. You need to look across. The euro is a big currency. It's not the dollar, but it's a big currency. The legacy families, they have dollars, euros, and everything. And they're based, many of them, in Europe. So you can't be singular of mindset. The 70% bull range on this particular platform is high set in this structure. Bang, that's where it is. You've got a low 1 miles away down here. Your low 2 is inside your 70% range, which is pretty high. This is called a high slung pattern. We've got slung. We know it. It's a green light. We've got the RH2. We know it. It's a green light. So you can see how our patterns, and the status of this is a triggered pattern. It triggered down here when you should have been getting long. You guessed it. Where should you have got long? 1769 down here. This is already an interim 1 status breakout in the process of getting. So I think Raul, who's a fan of Ethereum, is going to prefer our opinion to Peter Brunt. I don't know if he will, but I think he's bullish, and this is going to support the bullish bias over here. In short, where do we expect it to be? Through the target, 3,232. Also, theory, first structure in a new trend, overperformance expected, close only a part of your trade, which would be with very light leverage, and hold and utilize HVF method, overperformance tools discussed in detail in our community and recorded professionally in a learning environment for you to watch and learn, so that you can then subsequently follow practically while we implement and watch us discuss it and do it while trading live markets. Learning is doing. Learning is doing. So not only do you get the video, the time to encapsulate the theory, you get the implementation of that same theory in live real markets where you can be making gains. So here's asserting bearishness. We are saying at 3,252, which is a resting point rather than the end of the move, you'll probably be plus 5 or 10% on the Euro USD in dollars. So that will be a further 5 or 10% in the dollar terms. This structure is good. It's well aligned. It's looking promising. By the way, the next tallest histo for point of control is very close to this, which runs right through our funnel. You've only marginally got more here. And by different exchanges, which we've already looked, you can do for yourself, this is your primary point of control here on the pattern. Beautifully aligned with our funnel. So you can find out more about how we do this. First link below. Christmas, spoil yourself, build wealth, invest in learning, growing in a community of like-minded with real method, not indicator based. Okay, so that's Ethereum, the bullishness. So let's look at the lower time frame of the call that appears to be a slightly bearish nature. So I'm going to say goodbye to our structure. This is looking to me very much like a falling wedge. That has broken. And that is dovetailing and playing with and respecting the 2K level that it ran. Look at that clear head and shoulder there, by the way. We call those monarchs. You can find out why. They're the smallest and first. With a 2-180 and a real throwdown. Where did you kiss and stop? The 2K round number. You had a rally. You're now in a bit of Dow theory. However, you had the volatility squeeze. This is not normal Dow theory because you made a lower low after a lower high, but you are in a pattern structure that says this is pullback rather than big time frame reversal. You popped out, return move, huge rejection there on the hammer, and now you are getting back above this, plus an interplay on your 2K. Look at that little flag over there. Absolutely beautiful in running the 2K to the upside. So here's bearish Ethereum, here's bearish Bitcoin. He's noted that they're correlated. We are bullish both. So in short, in due course, I would expect to take out that high, not too far off. He may be expecting to take out these lows. So again, the alerts for where you be wrong, we can always be wrong. That's the nature of markets. You can be wrong. Events can suddenly pop up. I have an alert now here that says we have gone out the bottom of that falling wedge. It didn't hold for you. And these are alerts that say we're approaching making a new high, which by definition will point to the fact that you are not likely to be bearish. You're at a bottom. And of course, the next structural pattern that many of you could draw would look like this. Grab it, change the color. Again, you could do volume by price here. That would be an interesting point to take a little rest back and then break on up to the upside. So bullish on the Ethereum. Again, where did this low? That was your breakout that took you to the 2K and run it. We take that candle into consideration. And amazingly, despite taking a very low down in price candle, there was a breakout of the 2000 with a flag and further assumption, the point of control is still higher up. You can also see not a great deal of price behavior took place up top here. So right now, the real 70% of engagement is across here. And the point of control is across here, right basically where I drew the W bottom. Isn't that funny? We keep drawing patterns and the volume keeps showing up and saying, this is a key price level where you drew that neckline. I mean, I didn't know that, guys. You can accept that or you cannot. I didn't know that. That's how it would turn out. I'm just pointing it out as it pops up. What did we draw for you? W bottom. Two serious, very close to each other low points with your primary volume sitting right there. Smells good to me. I think we'll be up higher in a day or two, and we'll probably have gone to that point of control and possibly beyond. There's the alerts that say broadly you are accurate. These are the alerts that say for the wrong reasons Peter Brunt was accurate, in my opinion, if those are run. Thank you for watching. Did you enjoy that? Was it interesting? ETH bull, BTC bull. Hold on XRP. It may not be the first, but when it comes, it'll come big. You could be very close. This could be by before the end of quarter one over, and then it could have begun a very, very giving phase that comes hard and fast. Don't get drunk. Take your size off at the levels and the areas that we engaged. Have yourself an awesome Christmas. Thank you for supporting the channel. Share, like, hit that link below so that you too can get this quality of updates for the real reasons why markets do what they do on balance of probabilities, occasionally, of course, always being wrong in a no certainty game. Thanks again for watching, and catch you again later. Bye for now.